The motto of No-nonsense Forex is fortune favors the bold. The motto of the Fivers prop firm is discretion is the better part of valor. If you happen to be a no-nonsense Forex trader trying to use a 2% risk per trade strategy like the no-nonsense Forex strategy to pass the Fivers challenge with a 4% max loss limit, this could be a problem. Hey everybody, I'm Robert Donovan. Welcome to this episode of Tradecraft Solutions. This is a response to the video that you're seeing the screenshot of by Dillon Grech about adjusting profit targets to accommodate a low-risk prop firm challenge from a prop firm called the Fivers. Dillon has an excellent channel, and I recommend it highly. I'll put a link in the description below. But he was struggling a bit with this problem. The No-nonsense Forex trades a 2% risk per trade, that's the R1 risk, and a 1.5 ATR stop is the initial risk stop, and they use end-of-day charts. This is very aggressive risk management and translates into a potential drawdown of 15 to 20%, but it allows you to trade big enough lot size to make higher returns possible when you're right. The limiting factor on the Fivers challenge is that 4% max loss. It requires reducing your risk per trade to stay within that risk limit to somewhere between 1/3 to 1/2%, depending on your strategy and how many consecutive losing trades it tends to suffer during the drawdown periods. If you stick with that 1.5 ATR stop, it absolutely crushes your tradable lot size at that lower risk per trade. And when I say crushes, I mean down to things like 10 cents per pip to 60 cents per pip for a $10,000 account, and 20 cents to $1.30 per pip for a $20,000 account. So it's a huge drop. Clearly, the Fivers challenge, for reasons I'll go over in another video, caters to intraday traders, where ATRs are smaller and lot size can be larger. My first workaround attempt was to trade my strategy on the 4-hour charts, because I have also undertaken to pass the $40,000 prop firm challenge from the Fivers, which is the one with the $10,000 account. And I commented to this effect here, as you see in this slide. Dillon replied to that comment that his strategy didn't work in the lower time frames, though he did like the idea. His response to the problem, which he talked about in this video, was to risk slightly more. His reasoning was that the big drawdown he used that gave him a 0.3 to 0.4% risk per trade was anomalously large, so he decided to risk 0.5, half of 1%, and gamble that he would start trading. If he started trading during a drawdown, it would be one of the smaller ones, not one of the bigger ones. There was another guy named Daniel, I'm not sure if this is pronounced Stoica or Stoica, asked how I dealt with other things like exit signals and moving stops on the 4-hour chart during times I couldn't watch the market, and I promised a video to explain what I was doing. This is that video. I do apologize for it taking so long, but the bottom line and answer to Daniel's question is that my approach was to try to enter the trades signaled on the daily chart by watching them unfold on the 4-hour chart. This did usually get me in at better prices and smaller stop distances so that I could trade bigger lots. However, trading it this way frequently required staying up really late so that I could move the stops to break even. My idea was, once I got that stop to break even, I would switch to the dailies. The trouble with that was, very often it didn't immediately go to that 1-hour profit target. And the 1-hour profit target, by the way, was based on the daily charts, not the intraday charts. So it could take a while to get there, and that often required staying up staying up pretty late, cut into my sleep time. It would often conflict with my work hours, and I was an absolute zombie there for a few days. I just had to stop doing it, so I have. And I decided instead to go back to trading the daily charts, take the signals directly from the daily chart, but figure out a way to create a tighter initial risk stop that wasn't based on that ATR. And that was just to be used for the duration of the challenge. Bottom line is I didn't want the $4.50 entry fee that I put in to pay for this challenge to go to waste. This is why it took so long to get the video out. I've been messing around with this. I was able to do it with my strategy. I will caution you right here that just because this worked for my strategy doesn't mean it will work with yours, but I will go over what I did in some detail, and perhaps it can be of use to you. The first step was I decided it'd be a good idea to determine the range of lot size that was big enough to pass the challenge. The smallest the Fivers will let me trade is 1 microlot, which makes or loses 10 cents per pip. My strategy on the daily charts nets me about 68 pips per trade. That's about $6.80 per microlot. The average profit I need to pass the challenge is the $600 profit target divided by the average number of trades my strategy generates in any 6-month period, which is about 20 trades. Since I am only about 63% profitable, I divided by 0.63. You wind up with $47 per trade on average needed to pass. And if you divide that $47 per trade by the 680 per microlot, you get 7 microlots to trade minimum. And so I have to trade about 7 microlots per trade with my strategy in order to have a decent chance of making enough per trade to pass this challenge over the course of 6 months. So if I take that $40 risk per trade, that's 0.4%, divide that by 7 microlots, that's 7,000 units of currency, I come up with a 57 pips max stop size. So this should, by the way, if you have not yet decided to pay for or enter a prop firm challenge, this exercise should inform the decision of which one it is most cost effective to pay for. Don't buy one that's cheaper if the account size to start is too small to trade the minimum lot size you need to make enough to pass. So this information now in hand, I could have just chosen to use a 57 pip stop, but if recent price action allowed for something closer, I was wanting to take advantage of that. So I came up with the following rules for applying this. I basically am going to be using the highs and lows of recent pullbacks against the trend to set stop points. First thing on the stop rules is I always try to use the daily 1.5 ATR stop first. If the daily ATR is small enough and I can get away with it within that 57 pip stop or less, then I'll do that and save myself the trouble of doing all the rest of this. Usually that's not the case, so if the 1.5 ATR stop is too big, I look for a closer low or high of a recent pullback on the daily chart. And I'll go over when we get to the charting examples of exactly how I do that. But for now, just understand I'm looking for a low or a high of a recent pullback, highs for short trades, lows for long trades. My goal is to go no smaller than about 25 pips. Any smaller than that, you just wind up either becoming a scalper against your will or you just get whipsawed all to hell and gone. So if the daily chart is no help, I go to the 4-hour and then the 1-hour. If neither of those are any help, then I just default to a 57 pip stop distance. Your default stop distance will differ based on the number of positive net pips per trade your strategy generates and how many trades it generates in a given 6-month period. I'm only using pullbacks and lower time frames to set the stop. I'm not using these pullbacks to predict any price movements. I'm not using these pullbacks to set any R1 profit targets. I am using this only to set a stop and nothing else. Take my entries from the daily charts. I take my 1 ATR R1 profit target from the daily charts and I use the 1.5 ATR trailing stop on the daily charts if the trade goes far enough to trigger its use. So as you have already realized by now, I'm sure there are a few caveats to keep in mind if you're going to do this. First one being none of this is or has been intended as financial advice. I am a random guy on YouTube telling you what I do in my trading for a prop firm challenge to try and pass it with an end-of-day strategy. Test all of this stuff. Test it with your system on your strategy and the markets you trade before risking any actual money on it. The other thing to keep in mind is that we are using smaller stops here, and smaller stops do tend to generate more losing trades in any time frame. The big thing is you can get stopped out of otherwise profitable trades at a loss that you would not have taken if you had used the 1.5 ATR stop. In other words, the market can go just far enough against you to hit that smaller stop to result in a profit that you miss because the stop is too close. As it happens with my strategy, and this could be specific to my strategy because my strategy is not a straight no-nonsense Forex strategy. I do trade end of day. I do trade with indicators. I am a trend follower, but I use a price action-based entry trigger as the entry trigger for all my trades, and that creates a big difference in the way this thing trades. So with my strategy, I am able to treat those whipsaws that I get because I'm using the stop that's smaller. I'm able to treat them most of the time as a do-over option. A few times it will cause just another additional loss. We'll do an example of that. It turns out in the chart examples I have an example of how this works in one such circumstance. You'll see that. But once you pass the challenge, and this is the thing, this is only for the duration of the challenge. Once you pass the challenge, go back to trading normally. No point in causing yourself all this grief. Once you pass the challenge, you'll have a much bigger account. You will not have a time limit. So you can trade very conservatively and make whatever return you need to make, however long it takes you to make it. Okay, folks, that brings us to the charting examples. For this demonstration, I wanted to use a system that was a little bit truer to the no-nonsense Forex way of doing things than my particular strategy is. So I wanted to find one that used indicators only, and the entry trigger was the indicators lining up. I picked the one that Dillon used a few weeks back, or a few months back now, on this video here that you're seeing a slide for, because it looked like a pretty good strategy and it would lend itself to working with this kind of a stop, and it didn't generate a whole bunch of trades. So I used that system, and the system that he used for that test was this. The WAE 70, the green bars have to be above the explosion, the DPO 20 is positive, and the SSL channel 12 is crossing over the moving average of the highs. For shorts, the red bars of the WAE 70 have to be above the white explosion line. The detrended price oscillator 20, DPO 20, is negative, and the SSL 12 is crossing under the moving average of the lows. I'm going to switch to this chart here where we show the ATR because we need to know the ATR to do this. I went just randomly about 8-9 months back. I did this basically just at random. I was trying to find a variety of trades that worked, some that didn't, and a couple of that were unique to what you can get with this stop strategy. So this is what I came up with. Started on October 21st with a long trade signaled by the strategy at 1.1856. We're going to call that 1.1857. The 1 ATR was 71.5. We'll call that 72. Half of 72 is 36. We add 36 to 72. We get 108. 108 would be our stop using the straight no-nonsense Forex approach. That is bigger than the 57 pip stop that I calculated. So I am going to look for a closer short-term high or low to set the stop. Now, how am I determining a high or a low? That is very simple. A short-term low, as I am defining it for this exercise, is the low of any candle that has on either side of it a candle with a higher low. Pull up the highlighter here. That would be something like this, or this, or this, or this. Okay? A short-term one candle high would be just the opposite. That would be the high of any candle, on either side of which is a candle with a lower high. So that would be something like this, or this. And it turns out this one is both a short-term high and a short-term low. Which one you respected would be determined by the direction indicated by your indicators lining up. So that is how I am determining the highs and lows with the candlestick charts. I am also using the closing charts as well. A one candle closing high or low would be the close of any candle on either side of which is a candle with for a high would be a close with a lower close on either side of it, and then a one candle closing low would be the close of any candle on either side of which was a candle with a higher close. So you see these right here. And the reason I am using that definition is very simple. I wanted it to be a simple definition, something you wouldn't have to get too bent out of shape with when the market was moving fast. But also, I want it to be defined concisely and clearly enough so that any two people looking at the same price chart will see the same highs and lows, and therefore can set the same stop points. It is also codable so you can test it in PineScript or any place else you might want to try to test this stuff, but you want something that is defined enough that you can code the thing, and that was my goal with this. So that's why I'm doing it this way. And in fact, I suspect that now that you know what to look for, you'll have a hard time not seeing them. I do that just because I'm evil. So this low here would be the nearest daily chart short-term low, and that was too far away. It's at 1688. It's even bigger than the 1.5 ATR stop, so that won't work. I generally check the candles first and the closes. Closing low was closer, but not. It's still 1707, still no good. So now we have to go to the 4-hour chart. And here's our trade. We've got one here that is too close, 41. That's 15 pips away. That's less than 25. We have another one here, which is too big. That's 1.1760. Looks like we have a lower close there. Let's check the closing prices here, the closing line chart. And it looks as if we have 1821, 56 minus 21 is 35. Let's call it 36 just to make sure we're well past the low if we get stopped out, or we're truly past the low if we get stopped out. That'll give us 11,101 units of currency we can trade. That would be a 6,000 first tranche and a 5,000 unit second tranche. So that would definitely get us there. Let's go back to the daily chart. We see that trade basically went against us right off the bat, got stopped out the very next day. As it happens, the 100 and what is that? That was a 72, right? Yes, the 108 pip stop that would have been the 1.5 ATR was also hit just a few days later, and in fact got hit on the very day that we were signaled to go short in the opposite direction. So on the 28th of October, we got this trade at short at 1.1746. The ATR was 69, so if we did 70 is 35, so let's call it 34 and a half. It's okay. So if we figure 70 is 35, 105, let's call that 104. All right. And so 104 would be our 1.5 ATR no-nonsense Forex version of the stop. And what we're looking for now is a short-term higher high that we can use to set a stop. This one is the nearest on the daily chart at 1881. That is too far away. That's a good 140-something pips away, I believe. So let's not go there. The closing one is going to be a little bit better, but it's not going to be enough because I can see that. Yeah, it's not. Okay. Yeah, we got 1857, so still no good. Back to the candles, to the 4-hour chart. And here's our trade on the 28th. Do we have anything going on interesting here? This is a high at 1839, which is still too far away because there's our entry at 1746. So we have a higher close here. Let's see if we can get away with something with that here. Do we have just, yes, 1795. Okay, so that's going to be 35 pips there. We will call that good. We did actually have a closing short-term high at 1751, but that was a mere 7 pips away, so it was far too close. We could not use that. So there we go. And that is basically, I mean, it's not rocket science here. You get the idea, I'm pretty sure by now. Do I need to go through every single trade to show you this before you get it? I don't think so. It's a very simple strategy. There is one trade in all of this, though, that I do want to talk about, and that is one, I believe it occurred, yes, this one here on March 1st of 2021, because I do believe I warned you that you could get stopped out prematurely of an otherwise profitable trade that the larger No-nonsense Forex version of the stop would have kept you in for. That is this trade right here. It occurred on March 1st. Let me go ahead and drag the 4-hour charts forward so that we can find the darn thing here. Okay, March 1st at 20:48. Now, if we go to the daily chart here, on the 1st, we would have been signaled to close at 20:48, 1.2048. The nearest high that we could have used, the short-term high, was all the way up at 1.2243, which is clearly, it's almost 200 points away. It's way too big. So we then had to go to the 4-hour chart. And on the 4-hour chart, we had a high that was really close at 2069, which was less than 25 pips away, so we couldn't use that. It's 21 pips. We had a high here that was at 2093, which was within the limit. That would be 93 minus, was it 93 minus 48, so 93, 93, 53, 50, 45. So that would give us 8,888 units of currency to trade. Okay, 8,888 units of currency to trade, and that would have been our stop. Now, that would have put our stop 45 pips higher than this, would have been 2093. And where we got there, and it was stopped out a few days later, or a few hours, actually about a day later. So let's go to the daily chart here. It was stopped out, what was the high there? 2101. So basically we would have been stopped out either that day, no, that was a down day, so we would have been stopped out the very next day at 2094. Yep, so we got it. Now, this is an example of what I call the ability to use the do-over option. You see this blue line. I'm not sure how. Make this a touch more visible to y'all on YouTube and any place else I tend to put this thing. All right, there we go. There, that is what I do on a do-over. If I get stopped out and everything else is still saying sell in this case, or buy, depending on what the trade is. But if everything else is still saying sell, except maybe for that WAE70, because it's going to show a weakened trend because we've got a pullback going, which is why we got stopped out. But if all my other indicators were to say that, and I trade pullbacks, so this would not be a problem for me. But if all my other indicators are basically saying sell in this circumstance, I will place a stop order the day I get stopped out, on this day. Right, as soon as I get stopped out, on the very next bar, at opening of the next bar, 2 o'clock my time, right, 5 o'clock Eastern, I will place a stop order at this original entry point here on the close there at 2048. And I'll put a stop at 2093 again. So on this day, we opened, we went high, we went low, and we closed lower, and we got stopped back in at this point here, and the trade went our way. That actually, you did not get stopped out here. The trade went far enough to trigger the 1.5 ATR stop from the closes, and this almost got stopped out, but you were still in the trade. You actually didn't get stopped out till sometime around right here. So that was a very profitable trade. In this case, it worked. It doesn't always. Sometimes you just get an additional small loss, but the advantage of being able to trade quite a bit bigger size without risking more money is, for my strategy, worth it. please test that with your strategy because your mileage may vary. Just because it works for me does not mean it works for you. Okay, so after you do all of this, the question is, by April 21st, 6 months after October 21st, did you hit the profit target using this strategy? The answer is no, you did not. There's good news and bad news there, though. The good news is you were never down even 1%. At note, the most you lost was about $80 if you didn't take the do-over trade, or if because you had a loss, you had a losing trade right before that, I believe. But the idea here is that you had a very small drawdown. You only had less than 1%. You only had 2 losing months if you didn't take the do-over trade. You only had 1 losing month if you took the do-over trade. But I hear you say, yeah, okay, great, Donovan, but we still didn't make the profit target. What are you talking about? Well, there's something I would like to draw your attention to, which I found on the Fibers website, and that is this. They talk about the time expiration. Let me just read this to you. The relevant part here that you need to keep in mind. A trader on a risk management program who had not reached all the trading goals of level 1 but have a 2.5% net profit or greater may request a 30 days extension. Extension will be given upon email or chat request only and maximum twice. So you can basically get up to 60 more days to pass this thing. Now, as it happens, if you took the do-over trade, you'd have been ahead in excess of 4%. So you'd have had, 1 point something percent to go to pass. If you didn't take the do-over trade, you had about 3.4 or 3.5%. So you'd have, 2.5% to go to pass. So that would be something I think with this strategy, 1 or 2 more decent trades, and you'd have definitely gotten it there. I think it's very likely that you would pass. And once you've passed, you don't need to worry about the time limit anymore. Because the thing that's hurting us as no-nonsense Forex traders is not the fact that we have to reduce our risk. It's that we have that limited 6-month time frame with a strategy that kind of goes on a slow burn to success. So that is my approach to the problem here. I have decided to use the smaller stop. Hopefully, some of you will be able to find this helpful and it'll help you pass a challenge. That is my goal. It would be great to me if all of us watching this, or me making this, if all of us were paid prop firm traders this time next year. I would think that'd be awesome. I mean, how great would that be? But if this is of help to you, I would really like to know. If you have questions, please put that in the comments too. If you found it useful and would like to, and you think it'll help somebody else, give it a like, give it a share. That'll also help support the channel and help me with the YouTube algorithm. I do read all the comments. I'm not sure when I'll be able to answer. If everybody has a similar or the same question, or if I get a few of the same questions repeatedly, that may generate a video answering those questions. So thanks a lot, my fellow trade crafters, for watching if you've stayed with me this far. And as always, may the balance of your day be awesome, and we'll see you next time.